Hello and good afternoon friends, welcome once again to the CEC-UGC live lecture. Dear friends, as you know that we are carrying a series on international trade, and under the series we have conducted numerous lecture. Once again we are going to continue this very series, and today we are going to discuss on balance of payment and foreign exchange. And for this we have again with us in our studios Dr. Rajiv Shukla. Dr. Shukla is a PhD Program Coordinator in Indian Institute of Foreign Trade. So let's take advantages from his experience and try to understand what balance of payment and foreign exchange is. So first of all, I would like to welcome our guest Dr. Rajiv Shukla. Dr. Shukla, welcome to the EduSet lecture. As I've already said that it is a series based lecture. I hope that all the students who might have watched us in our previous lectures also would be able to recall. And now over to you, sir.
Yeah. Thank you, Geetka. Hello friends. In last lecture, we have discussed a lot about our international trade theories, international trade terms of trade, international terms, international trade regarding the scenario of globalization, liberalization and privatization. Now, we are going to discuss today what is the meaning of balance of payment, which is a very crucial and important topic in point of view international trade. And after that, after completing of balance of payment, then we will discuss about the factor of foreign exchange. We are now in a globalized world, and the free trade is now is being a tool of every world economy. So if you can say, if the Indian economy grew without the free trade or without the world economy growth, there is no possibilities. If you can say the world economy, we are integrated our economy with the world economy with the help of some free trade associations, with the help of some SAARC and ASEAN type of associations. So overall, the free trade is one of the major approach. And if we are talking about the free trade, then we must know about the foreign exchange. So first, we started with the help of some tools of the international trade. The one is balance of payment. So what is the meaning of balance of payment? Before we start, let's recap about the international trade, and under the international trade, what the two countries have integrated with each others and what they perform under the consideration of international trade theory. So first, as you recall, the international trade refers to trade between the residents of two different countries. And also you were very well aware about this fact that what is the necessity of the balance of payment, or what is the necessity of foreign exchange, why it is necessary. If we talk about the international trade scenario, if we talk about the globalization scenario, is there any necessity of the balance of payment? Is there any necessity of foreign exchange? Yes, there is a very much mandatory necessary about the fact of foreign exchange and about the fact of balance of payment. Balance of payment, you can say in a simply manner that it is a sign of status of economy. So before we start, first we know how the necessity is required to balance of payment or the foreign exchange. So you can say the exporter requires payment in the currency of the exporter's country. The exporter requires payment in the currency of the exporter's country, and whereas the importer can pay only in the currency of the importer's country. So if you can again think over this, if the exporter if the payment in the currency of the exporter's country, and the importer can pay only the currency of the importer's country. That's why we need a foreign exchange, or you can say exchange rate. So a need therefore arises for conversion of the currency of the importer's country into that of the exporter's country. Simply mean, if you are exporter or if you are an exporter country, then you require payment in the currency of the exporter country. And if you are an importer, so you can pay only in the currency of the importer country or the domestic country where you want to the trade of the concerned goods. So therefore, a need arises, a require arises therefore for conversion of the currency of the importer's country into that of the exporter's country. So this is the necessity why the foreign exchange or the exchange rate require. If you can think, what is the meaning of balance of payment? As I said, balance of payment is a parameter, is a sign of the status of the economy, of the any economy. If you can talk about the status of the economy, then you must know about the fact if the balance of payment is unbalanced, then you can say the economy is not in a very appropriate manner. So every government, every economic control or authority wants to balance of payment. That's why we call a payment in the balance form. So what is the balance of payment? So balance of payment is in a simply, or the smaller form is the BOP. So you can say balance of payment is the systematic summary of the economic transactions of the residents of a country within the rest of the world during the specified time period, normally a year. So you can see over slide that what is the meaning of BOP? BOP is the systematic summary of the economic transaction, and as I said, if you know the summary of the particular economy, then you know the status of the economy, either the economy in a decline mode, either the economy in a appropriate mode, either the economy in a exploring mode. So if you know the balance of payment of the particular economy, then you must know about the status of the particular economy. So balance of payment is the systematic summary of the economic transaction of the residents of a country and with the rest of the country within a given period of time, or the period is normally a year. Now we talk about the features of BOP statement. What is the features of balance of payment statement? Economic transactions, as you have seen in earlier slide, economic transaction is the record, is the summary of the economic transaction with a resident country to the rest of the world or the trading partner. So an economic transaction arises when value are exchanged or moved between nations. The simple meaning of transaction, a give and take. So you can say a economic transaction arises when values are exchanged or moved between nations, and these may arise from movement of good in the form of export and imports, rendering of services abroad and using foreign services. So in the form of features of BOP statement, you can see that there are two types of, there are several other types in a coming slide, but here you can see two types. First is rendering the services from abroad or the using of foreign services, or the export or import in the form of goods and services. So economic transaction, when we talked about the feature of BOP statement and we talked about economic transaction, that simply meaning when you export of the particular commodity and when you import of the particular commodity from the rest of the world, or when you export the particular commodity from the domestic territory or the domestic country or the resident country. So here are two features. Now we move to some of the other features. You can see a gifts, grants from one country to another, investment made abroad or received from abroad. As I said, there are some categorization of balance of payment statistic. Once the receipt and once the payment or expense. You can see as some receive amount, or you can say about the amount which you pay of the particular country or the trading partner. So BOP statement is the balance of a statement. There is no mean to say if there are only a receiving scenario. No, you can also a statistic of the payment in BOP statement, and you have also a statistic of the receiving payment from in the form of exporting, or when you say the sum of the payments, it seems like if you import a particular good, then you have to pay for the particular commodity which you imported. So now you can see the third one point, gift, grants from one country to another, the investment made abroad or received from abroad. Investment made abroad, this call you can say some outflow of the money, and when you received from abroad, this is the inflow of the money from the rest of the world. Income on investment received from abroad or remitted abroad, and the next feature is increase decrease in international reserves of the country. So these are the features of BOP statement. With the help of these features, we can identify what is the meaning of BOP statement, which we have seen in first one slide, The BOP statement is a summary of the statistics of a one resident country to the rest of the world within a given period of time. Is the normally a time is a year. So now here you can see what is the meaning of transaction between resident with the non-resident, a flow statement or the periodicity. Now you can see in completion of balance of payment, as I said, there are two options, or you can say there are two clause in the BOP statement. One is the currency inflow and the currency outflow, which is the call of if you can export of the particular commodity, then you have to receive a particular income in response of the exported commodity. When you import it of the particular commodity from the rest of the world, then you have to must pay about some expenses in proportion to the imported goods or the services. So there are two clauses, there are two blocks, you can say a BOP statement. In completion of the balance of payment, double entry principle of accounting is used. What is the meaning of double entry? First is currency inflow in the form of credits on foreign exchange. When you receive the foreign exchange in proportion to your export or the some types of services which you are rendering from abroad. So currency inflow, each foreign exchange. Currency outflow, debit form, when you expend foreign exchange. So these two types of blocks, two types of entry you can say in a BOP statement, one in the form of credit and the second one is form of debits. Credit form is the currency inflow when you earn foreign exchange, currency outflow that is when you expend foreign exchange. Now BOP statement is presented with three major components. Normally, BOP statement is presented with three major components. One is current account, and what are the ingredients, so you can say, or what are the contents of under the current account, which we will disclose in coming slide. So now BOP statement is presented within three major components. First is in current account, the second is capital account, and the third is official reserve account. And what are the contents under the current account, capital account and the official reserve account. With the help of some graphical presentation or with the help of some figure, we can identify in coming slide. You can see balance of payment. There are three categorization as I said. First is current account. And what are the contents or what are the components under the current account which we have? There are some particular export and imported of the goods. The first one is goods accounts, export and import. The second one is services account, travel, transportation, insurance, etc. The first one is goods account, the second one is service account, the third one is unilateral transfers in the form of gift, donations and subsidies. The fourth one is investment income, interest, dividend. So these are the four categories which is the under current account. The first one is goods account, export and import. The second one is service account. In the service account, we can identify a travel, transportation, insurance, etc., banking, unilateral transfers in the form of gift, donation, subsidies, investment income, interest, dividends. These types of goods and services are included under the current account. Now the second one is capital account. In capital account, we have foreign direct investment, FDI, portfolio investment. Now the private short term capital flows. These are the three categories which are included under capital account. Normally, foreign direct investment is simply a meaning when the concerned rest of the country or the particular organization which situated in the outside of your domestic country territory, and when we invested in the flow of foreign direct FDI, then you receive a foreign exchange or foreign reserves in the form of portfolio investment. private short-term capital flow. These are the three categories which are included under the capital account. Now the third one is official reserves accounts, and under the official reserves account we have decrease or increase in foreign exchange reserves. Decrease or increase in foreign exchange reserves. These are the features of the balance of payments. There are three categories: current account, capital account, official reserve account. There are four types of services or the goods or the part of contents which we included in the current account, which are goods account, service account, unilateral transfers, investment income. In the capital account, what we have? Foreign direct investment, FDI, portfolio investment, private short-term capital flow. The third one is official reserve account, is the decrease or increase in foreign exchange reserves. Now, BOP accounting, how it manage? The first one you can see, export of good US dollar to 200, realization of deposit in the bank abroad. Import of goods USD 150 MN, the payment made from bank account abroad. The amount spent by foreign tourist in the country is the US dollar 40 MN. How we can manage about these five features in a particular fig form is the figure form, where would you like to know about this fact ki how the BOP accounting form. So these are the features we can put all the things in the form of BOP accounting. The first one is export of goods USD 200, realization of deposit in bank abroad, the import of good USD 150 MN, payment made from bank abroad, the amount spent by foreign students in the country USD 40 MN, and the received goods are as gift from another country is USD 60 million, and the export of commodities from USD 80 million on a government deal. So payment in gold by the importing country's government. Now in the form of all the things we can put in the form of balance of payment in the accounting form. Here you can see the current account, the credit form, debit form, and the balances is the merchandise trade 280 and 210, which we received and which we in the form of outflow, in the form of debit 210. Balance kya hai? Is the 70, is the positive. Now the trade in services, suppose 40, there is no payment made from the domestic country to rest of the world, 0, the balance is 40. Unilateral transfers is the 60, there is no made expensive, then the balance is 60. In the form of capital account, bank balances abroad 150, but the debit is 240. The payment you made is the 240 and the payment you received is 150. Here is the balance is in negative form minus 90, and the official reserves abroad is the debit form in the form of 80 only, then the minus 80. So these are the accounting method of the balance of payment, which we recall about how the balance payment accounting made. Now what is the importance of BOP? If we talk about the features of BOP, if we talk about the necessity of BOP, if we talk about the need of BOP, so let's discuss about the importance of BOP. Why is so important, or as I said earlier, is the mandatory or is the status sign of the particular economy. So what is the importance of BOP? The judge economy and financial status of a country in the short term. There is the finest parameter. With the help of BOP statement, you can judge of economy, the financial status, and as well as the economic status of the particular country or the particular economy. Deficit signifies a tendency to take stiff measure of diminishing imports. Suppose with the help of BOP statement, if you can identify that the import rises expensively and the export diminishing in the form, then you have to be idea with the help of some BOP statement that you take a stiff measures for diminishing imports. With the help of diminishing imports or with the help of stiff measures, you can explore the more and more export oriented goods. So, with the help of BOP statement, deficit significance a tendency to take stiff measures for diminishing imports, exchange control, restrictions on repartitions of dividend and interest. So, how what is the importance of BOP? First, you judge the economic and financial status of the particular economy in a short form. Deficit signifies a tendency. You can take a stiff measures if you can recall with the help of BOP statement that the imports are quite high in comparison to export. Then you immediately take a stiff measure for diminishing imports. Now, the third one form, consistent BOP deficit has an unfavorable effect on exchange rate, depreciation of the currency. Consistent BOP. Normally the government try to balance of the particular statement if the consistent of the BOP in the deficit mode, then you can say is the unfavorable effect of exchange rate in the form of exchange rate declining. So, central bank intervenes through its regulatory stock or control volatility of the exchange rate. If the BOP of the particular country is in a deficit mode and is stable from the earlier sum of times, when you think about the central bank must have take some measures to regulate or to control the volatility of the exchange rate, because if the BOP consistently in a deficit mode, then this is not a favorable effect on exchange rate. And incidentally, the currency is in a form of declining, or you can say depreciation of currency. So, immediately central bank takes some interventions through the regulatory stock or control volatility exchange rate, and with the help of these measures we can regulate, or you can say we can take some fruitful step to balance the particular statement scenario, or you can say some balance of payment. Now, link between the national economy and international activities. किस तरीके से ये लिंक होता है? There is a link between the national economy and international activities. How? National income is equal to consumption plus saving. We aware about this fact. National spending, consumption plus investment. We know about these basic facts कि national income is equal to consumption plus savings and the national spending is equal to consumption plus investment. So, national income, if you can say national income minus national spending is equal to saving minus investment. So, we can say if a nation's income exceeds its spending, saving will exceed domestic investment. If a nation's income exceeds its spending, savings will exceed domestic investment, because savings is also a form of some of the investment, and after that you can, if you have saving more than more savings, then definitely it comes from in the form of investment. So, we can say, so if a nation income exceeds its spending, saving will exceed domestic investment. Now, we can see a nation that produce more than it spends will save more than it invest domestically and will have a net capital outflow. With the line of this saving minus investment, we can say a nation that produces more than it spends will save more than it invests domestically and will have a net capital outflow, and this capital flow will appear as a combination of capital account. deficit and as increase in official reserves. So these type of steps, if we can identify with the help of balance of payment, then we can regulate our economy in the appropriate form. We can know the status of the economy, and if the economy is in deficit mode, then we can take some stiff measures. If the import is high, if the export is declining mode, then with the help of balance of payment statistics, we can identify the actual situation of the particular economy or the particular country. So that's why a balance of payment is a very necessary tool to know the status of the economy scenario. Now we move, our second one segment is the foreign exchange. What is the meaning? We heard about this word, a foreign exchange, and what we know about this fact, why it is necessary about the foreign market scenario. Foreign exchange, currency exchange, exchange rate, we heard a lot of times. But what is the meaning of the foreign exchange and why it is necessary in the international trade scenario? Here we look. Meaning of foreign exchange. What is the meaning of foreign exchange? The term foreign exchange implies two things. First is a foreign currency, and the second thing is exchange rate. We all know, as I said, that if the exporter wants to a payment of the particular goods when he export it in the resident form, in the resident country's currency form. So foreign exchange, why it necessary? If you wants to a payment in the form of resident country and the receive of the payment from the rest of the country where you imported the goods, then you want to a conversion of your currency in the particular form. So foreign exchange, the term foreign exchange implies two things, foreign currency, and the second thing is exchange rate. Foreign exchange generally refers to the foreign currency. There are so many things included in the form of dollar, euro, yen. There are several currency, yuan. So these type of foreign exchange generally refers to the foreign currency. And the other part of foreign exchange is exchange rate, which is the price of one currency in terms of the other currency. We all know that the $1 is equivalent to in Indian currency is near about a 61 point something. So this is the foreign exchange rate. If you talk about the exchange rate, what is the meaning of exchange rate? Which is the price of one currency in terms of the other currency. So we can convert the Indian rupees in the form of US dollar, or you can see a US dollar in the form of Indian rupees, then we can recall about the exchange rate. So one US dollar is equivalent to 61 point something rupees. So this is the exchange rate. When we strong in the form of 60 rupees, then we can say our currency is in a strong mode. When when our currency depreciation mode, then we can say a US dollar in the form of 67, 65. Then we can say that our currency is not in appropriate form, is in declining mode. And if we can say a currency is in a strong form, then we can maybe a look in the form of $1 is equal to a 59 or the 58 rupees. Then we can say our currency is in a very strong form. So here the forex is the international market for the free trade of currencies. Trader places order to buy one currency with another currency. So forex is the international market for the free trade of currencies. One of the major economics, the Hartley-Withers. According to Hartley-Withers, what is the meaning of foreign exchange? The foreign exchange, he said, foreign exchange is the art and science of international monetary exchange. We talk about exchange, and Hartley-Withers said in the other word form, the foreign exchange is the art and science of international monetary exchange. And the forex market is the world's largest financial market. You may be surprised to know over $4 trillion. Trillion dollar worth of currency are traded each day. It's amazing to know for that person who are not aware about the fact of the forex market. Then you can realize the forex market is the world's largest financial market. $4 trillion worth of currency are traded each day. The amount of money traded in a week is bigger than the entire annual GDP of the United States. You can imagine how the market is big. The amount of money traded in a week is biggest the entire amount of GDP of the United States. And the main currency used for forex trading is the US dollar. That's why the dollar is a very strong form in the international forum. The forex market, you can look over the slide, $4 trillion worth of currency traded each day. And if we calculate in a week form, in a total week form, then you can realize the entire annual GDP of it's equivalent to the entire annual GDP of the United States. So you can think how the forex market deals and how the forex market is why the forex market is the biggest financial market. You can look, foreign exchange market is that market in which national currencies are traded for one another. The major participants in this market are commercial banks, forex brokers, and authorized dealers and the monetary authorities. These are the dealers or these are the participants, you can say, which are involved in the trading of the in forex market. And besides transfer of funds from one country to another, speculation is an important dimension of foreign exchange market. Besides transfer of funds, there are from one country to another, speculation is an important dimension. So it's where money is one currency exchanged for another. And it's already the world largest market and it's still growing quickly. A market extensive use for information technology. That's why I'm making available to everyone. Trader can profit from both strong and weak economies. It's not only dealing a developed economy, it is not only a dealing in the developing economies. And you can say if the trader or some of the authorities or some of the brokers can profit from both strong and as well as weak economies. Trader can place very short term orders which are prohibited in some other markets. Very short term order in the half of the second, and you can lose and as well as you can profit in a very high. So can place very short term orders, and that market is not regulated, and broker commissions are very low or non-existent. The last thing is that the market is open 24 hours a day during weekdays. 24 hours a day. What is the terms related to foreign exchange? There are several terms. There are some highlighted. I would like to some pointed out the major highlighted. One is foreign exchange reserves holding of the other countries' currencies. Retail foreign exchange platform, speculative trading of foreign exchange by individuals using electronic trading platforms. The second one, foreign exchange controls. Control imposed by a government on the purchase sale of foreign currencies. There is a government control on the trading of the foreign exchange or the currency, purchase and sale of foreign currencies, retail of foreign exchange platform. Foreign exchange risk arises from the change in price of one currency against another. There is a risk. Suppose if a broker place an order in a very short form, as I said, is the half of second also. So if you can place and within a second or within a half of second the currency rise or the down in the in terms of another currency, then you can immediate a loss. And if you can place an order in a very short form or immediately the currency which was very low, immediate rise, then you can receive a high profit. So, international trade, the exchange of goods and services across national boundaries. These are the terms related to foreign exchange. Foreign exchange company, a broker that offers currency exchange and international payments. Bureau de change, a business whose customer exchange one currency from another. Currency pair, the quotation of the relative value of a currency unit against the unit of another currency in the foreign exchange market. So, these are the features or the terms of the related of the foreign exchange. We earlier several times heard about the exchange rate, which is a correlated with the foreign market, which is you can say as is also a tool of the foreign exchange market. What is the meaning of exchange rate? I talked about the exchange rate is the you can say a price of the particular currency in comparison to another currency. So, exchange rate according to Haynes, exchange rate is the price of the currency of a country can be exchanged for the number of unit of currency of another country. As I said, one US dollar is equivalent to a 61.95 INR. So, the Haynes said in the same exchange rate is the price of the currency of a country can be exchanged for the number of unit of currency of another country. So, we can say exchange rate is that rate at which one unit of currency of a country can be exchanged for the another currency of the particular country. Now, it is the price for which one currency is exchanged for another. You can say number of use the words, but the main theme is that the exchange rate is the price of one currency which you are going to exchange from rest of the country currency or the another country currency. So, this is the price. What is the price of one US dollar in the form of rupees? You can say is the 61 point something 95. So, this is the price which we talked about the exchange rate. When the exchange rate fluctuate either in the high form or the low form, then it impacts not only a particular resident economy, but also in the foreign exchange market. When the currency of the India fluctuate, any country, when the currency of any country fluctuate, it impacts on the particular economy also or the country's economy also. Now, we move factor influencing exchange rate. What are the major or the minor factors which is influencing the exchange rate? As with any market, the forex market is driven by supply and demand. Forex market is also driven by a supply and demand. As the many of the market we have discussed in the previous lectures, that was also driven by supply and demand, and the foreign markets are also driven by supply and demand. As first one point, you can see if buyers exceed sellers, prices go up. If buyers exceed sellers, prices immediately go up, as in the normal market happen. Second point, if sellers outnumbers buyers, prices go down. The following factors can influence exchange rate also: national economic performance. Simple, if your economy is in a very good form, then definitely the exchange rate, the currency of the particular economy is in a strong form, and if the currency of the particular economy in the strong form is definitely impact of the exchange rate. Central bank policy, if the central bank take the harder step to diminishing the import, then definitely it comes in the form of positive impact of exchange rate. Interest rates, trade balances, import and export. As I said, if the import is low and the export is high, is definitely creating a positive impact on exchange rate. or the vice versa, if you can say the import is high in comparison to export, then definitely it's creating a negative impact on exchange rate. Political factor. In today's scenario, this is one of the important feature, you can say. Political factors such as election and policy changes. Sometimes it affects. When the government change, when the policy change, it definitely affects of the economy situation, and when the economy affected, then the exchange rate also affected. Market sentiment, expectation and rumors. I think this is one of the very important feature if we can talk about in today's scenario. Market sentiment, because the most of the you can see most of the rumors or the expectation what we have, and when it comes into a form in the market scenario, then we realize that with hold of the some expectation and the rumors, we can take decisions. Either we can borrow money from the regulating authorities, you can say banks, you can or with the help of some expectation and rumors, if you can recall some types of investment when suppose the budget is recently presented, and before the budget there are so much expectation, there are so much rumors that the budget comes with this and the budget will come this. So after get these rumors and expectation, most of the persons, most of the organization, most of the industry expatriate, most of the industry experts invested take some decision with the help of these predictions, these expectations, these type of rumors, what the budget will come with some fruitful news for the corporate and something else. So these expectations and the rumors counts very big manner in today's scenario, and it affects the overall economic scenario and as well as an exchange rate. When the economic scenario affected from these type of sentiments, or you can say a market sentiment, then definitely it creating a good or a bad impact on the exchange rate or the foreign trade scenario. Unforeseen events, terrorism and natural disaster. These are the unforeseen event, unknown circumstances, you can say. When it happens, this definitely affect the economic scenario and as well as the country scenario, and also creating impact on exchange rate. So these are the factors influencing, or you can say exchange rate impacting, or either the good or bad, but these type of factor influencing exchange rates. So despite all these factors, the global forex market is more stable than stock markets. Even then, if we talk about the stock market, most of all you show, you have seen in some news channels, in newspapers, that there are a very continuously slowdown or the progressive in the form of stock market. There are so much in a day by day, but there are so much, you can say there are so much instability in the stock market, because we heard about, we have seen about all the stock market declining, either the stock market very much up or the targeted best the record of in today's days. So these type of day by day changes in stock market, definitely it comparatively of the forex market, then the stock market is a very unjustable, you can say it's not in a form of very appropriate form in comparison to forex market. We can say the global forex market is more stable than stock market. Exchange rate change slowly by small amounts. Stock market rapidly grew up or the rapidly slow down form in a singular day. But we can talk about, if we can talk about the global forex market, it not happens. Sometimes it happens when the exchange rate high in a very small form or the low in a very small form. So it affects, but not in a very continuous manner. Now, types of exchange rate. There are several types of exchange rate. and when we deal of the forex international market, or when we deal in a free trade, then we can apply these type of types of exchange rates. With the help of these exchange rate, we can also aware about some risk, foreign market risks, you can say. So what is the types of? First one is fixed and floating exchange rate. The first one is fixed and floating exchange rate. What is the meaning of fixed exchange rate? Fixed exchange rate is the official rate set by the monetary authority of the government for one or more currencies. And floating exchange rate, the value of the currency is decided by the supply and demand factors. If you can deal on fixed exchange rate, and either the and you can purchase or the sale or the good of the fixed exchange rate, then you have to pay whatever you decided on that day. But if you can deal on floating exchange rate, then you have to pay or you have to receive on that form whatever that day, or whatever the that day when you are going to receive or when you are going to pay, you have to you receive only on the that currency form. Whatever the currency or the floating exchange rate on that day when you are going to receive or when you are going to pay. But if you can deal on the fixed exchange rate, then you have to pay whatever we decided today. So these are the types of floating and fixed exchange rate. Now the direct and indirect exchange rate. Direct method, under this a given number of unit of local currency, a given number of unit of local currency per unit of foreign currency is quoted. They are designated as direct certain rate because the rupee cost of single foreign currency unit can be obtained directly, and the direct quotation is also called from home currency quotation. And some indirect method also, under this a given number of units of foreign currency per unit of local currency is quoted. Indirect quotation is also called a foreign currency quotation. The buying and selling exchange rate are quoted as two-way quotes for purchase and for sale transactions by the bank. The very important feature is the spot and forward. The delivery under a foreign exchange transaction can be settled in one of the following ways: ready or cash, in a very hurried manner, you can say, to be settled on the same day. Tom, to be settled on the day next to the date of transaction. Spot, to be settled on the second working day from the date of contract. These are the very basic instinct feature. If you talked about the forex international dealing, then you must know about these basic instinct of the forex international market: ready or cash, Tom, spot, forward. To be settled at a date further than the spot date. So here you can see ready, immediate effect. Tom, to be settled on the day next. Spot, to be settled on the second working day. If you can deal in the form of spot, then you can identify that the payment will be settled on the second working day from the date of contract. And if you can deal on the forward forum, then to be settled at a date further than the spot date. There are some theories of exchange rate determination. We discuss in the coming lectures also. Here is a first a look of what is the meaning of the theories of exchange rate. What is the meaning of the theories and why is necessary. Theories which determine the prices of the forex rate considering inflation, interest rate, elasticity of prices. There are two types of method. First is long run theory and the second is short run theory. In the long run theory of exchange rate determination, we have, these are the theories which predominantly take into account of fundamental changes of the economy. Here fundamental changes refer to the change which are going to change the economic performance of the economy, purchasing power of all times to come. There are two types of theory which we are going to disclose in coming lecture. Here the meaning of the fundamental changes, that means a change which are going to change in the economic performance. And we, as I said, if the changing in the economic performance, then we definitely affect the exchange rate. And if we affect the exchange rate, then we definitely lose or receive anything what the economic scenario of the particular country we have. So, types of theory, there are two types: purchasing power parity, PPP. The first is absolute purchasing power parity and the second is relative purchasing power parity. The second one theory is the interest rate parity, the covered interest rate parity, and the second is uncovered interest rate parity. So, these are the theory of exchange rate. With the help of these theories, we predominantly take in the account the fundamental changes of the economy. Short run theory of exchange rate determination. Here we have seen long run theory. Now, if you look short run theory of exchange rate, these theory are based more on the current information. In the earlier slide, you can see these are the theories which predominantly take into account the fundamental changes of economy. These theory are not dealing with the current situation of the economy. They are dealing on the predominantly what is the change is going to be happen on particular economy or the country. And now, if you can look short run theory, these theories are based more on the current information or the immediate performance of the economic variables. And these theories try to take into account the short run factor which may be eliminated in the long run. Everybody knows if you can take account in a short run, definitely you can lose or receive a very high profit, or maybe it not so longer in the form of long run. But there are two types of theory. Short run theory is also determining factor of the international trade or the forex market, and these theory try to take into account the short run factors, what the influence factor of the particular forex market, and which may be eliminated in the long run. So, we will discuss about the facts, about the parameters of these theory and how these theory will be helpful to know or to regulate the forex, to minimize the forex risk also. So, with the help of these theories, we would like to mention here, if we relook all the things in the international trade scenario, forex market scenario, then we realize why the exchange rate is so important and why the BOP is so important and why these terms are correlated with each other. If you can left out one of the factor, then the forex dealing is not in a very appropriate form. So, these are the factor are very much bound together and everybody is comparatively correlated. If one effect, then definitely is creating a effect on the second one. So, this is the very important theme of the international trade, which is very much important for the competitive exam also. So, here in next lecture we will disclose about the facts of these theories in the long run and the short run, and also I will also show the exact scenario of the foreign exchange reserves of India in today's days. Okay, what is the external reserves what we have, and from the 2002 onwards 2014 up to what are the current scenario of the foreign exchange reserves and how is it useful or not. Thank you very much for listening very sincerely and carefully. Thanks a lot.
With this note, thank you, sir. Thank you so very much for giving us a deep insight into this topic, that is balance of payment and foreign exchange. And I would like to tell you all that if you want to access this particular lecture, you can definitely access us with the help of YouTube, as we daily say that we upload our lectures so that it becomes easier for you to understand the topic very easily and listen to the topic, listen to the lecture again and again. As well as I would like to tell you all that if you have any queries, you can mail us at info.cec@nic.in, so that the next time when Dr. Rajiv Shukla comes, we would be able to solve your queries. Thank you, sir. Thank you so very much for being the part of the EduSet lecture. Thank you, sir.